Listen only mode.
Is that now recording? It's not. Is it? It's not recording yet. It says start recording on mine.
Well, don't stop it, because it's recording now.
Sure. Well, it says start recording.
Well, you're recording, so I think it's a different thing. So you have to change it. Yeah, you have to start. Yeah, it's all good.
Yep. Right, so we're going, yeah? Cool, right. You don't have to do anything if you don't want to. I'm not forcing you to do anything. Right, previously talked previously about the importance of having a trading strategy, and in that webinar I briefly touched upon a couple of factors that can have a significant impact on your account. Now, first of all, emotion trading can be a significant negative impact, and then trade management, which I would argue through the use of stop losses can have a big positive for your account. And I think it's important to realise that before you press the button on a, I think it's important to realise that pressing a button on a trade is actually relatively easy, but now the tough bit is making a profit on your trading. Not only that, more specifically, making a profit that actually means something to your account. I would actually say that if you can successfully manage your positions, then you may not even have to get your decision making right much more than 50% of the time in order to make some good profits in trading forex. And if you're very good at trade management, you don't necessarily need to be right even more than half the time. Run your winners and cut your losers is a phrase that I'd imagine many of you have actually heard before, and it can be a difficult thing to put into practice, as you do need to be in charge of your emotions, and emotion trading can have a significant impact, as I said earlier. Psychology can be a part of trading and can be a key part of trading, and if you fail to get a check on your emotions, you can very quickly see your account being eroded. Now I'm going to focus today on how to engage trade management into your strategy and how it can help your trading. Within this, I'm going to touch on a few going to touch on some technical indicators that you can use to help you decide whether you should be running trades or cutting trades. Right. Now, the first reason for poor trade management, I believe, is due to emotion trading. Now, emotions can affect your strategy significantly, and you need to understand that you will not profit from every single trade. Nobody's perfect, and if your trade management is good, then I would say that you need to be, as I said earlier, you need to be right just on your direction a little more than half the amount of time to be successful. However, first of all, what you need to do is you need to accept that you will be occasionally making bad trades. At the end of the day, we're only human, and markets are not entirely predictable. Ideally, though, what you'd be looking to do is learning from your trades. Each trade you make, especially when you've got them wrong, I'd say keep a trading diary. Try and note down, if you've got a trading diary, try and note down exactly why you put a trade on and why it's gone wrong, and even actually why it's gone right, actually, because you can then look to learn from both sides of that. This practice may mean that you might feel that you need to tweak your strategy, but at the end of the day, it is all a learning process in the end, and what you're trying to do is you're trying to make sure that you don't repeat the mistakes if they can be avoided. As the slide says here, successful trading doesn't just happen overnight, it develops over time. So what are the emotions that can affect your trading? Well, emotions can come from both generating winning trades and also losing trades, but both can be a negative impact on your future trading, I would argue. Now, winning, the impact of winning trades, if you're winning, you can get greedy and you can get overconfident in your trading. Now, I would say don't get complacent, because it can lead to you putting on trades without the required thought process. And also don't get arrogant, because it can lead to you putting on positions perhaps in too great size, or just taking on too much risk ultimately. And excessive risk can certainly lead to costly mistakes, especially if you have a combination of complacency and arrogance. Yes. Was there a time? Is there a time? Yeah, I don't know. Don't know if there is a time or not. Maybe there isn't. Okay. Okay, so on the flip side of that, there are emotions that you get from losing trades as well, such like anger, feeling revenge, can lead you to trading in a very rash manner without any due consideration, and you need to try and avoid feeling resentful, because that will give you or a need to get even with the market. If you're having a bad trading day, I would say just let it go. Leave it. Never let a bad day get worse. Now, I'm going to talk about the perils of overtrading in my next webinar, but trust me, overtrading can be. But trust me, overtrading can be a massive and also costly mistake to your account. If you've made a mistake or a series of mistakes in a row, let it go. Don't trade out of anger or revenge, as you will be going against your strategy. And don't forget, you're not a gambler. Pride can prevent you from closing a position at a loss. Understand your limitations. Even the best trades will incur substantial, can occur in occasional losses. But being able to accept your losses comes with being a successful trader. Sort of takes me back to what I said earlier about learning from your mistakes. Don't wallow in your losses. Learn from them. Depression and fear can be a debilitating impact on your ability to press the button on a trade. For example, I've spoken to a lot of traders actually in the past, and I've spoken to a lot of traders over the years, and some that have got a few trades wrong and they've lost all their confidence. But if you feel this is happening, go back to your trading strategy. Remember why you're putting on your trading positions, and it should help you to find some clarity in your thought once more. If not, then look to make some tweaks to your strategy, but don't always ditch it altogether. These emotions that you experience are all feelings that you need to understand. Take a step back and think about your strategy. Is your strategy being compromised by emotions? Is your strategy, for example, being compromised by your emotions? If so, then try to think about how you can overcome these emotions and get back to your strategy. Trade management looks to remove or at least reduce the emotional side of trading by managing positions. Ultimately, try and be rational in your thinking. What you're going to have to do, what you need to do is stick to your plan. You want to be a consistent trader, and I would say your predefined trading plan and strategy will certainly help to drive this. And at the end of the day, what you always need to remember is you need to keep your eye on the prize. Remember why you are trading. And you've got the key tip here. If you feel yourself getting overcome by emotion, take a step back, deep breath, ask yourself, should I be doing this? Okay, stop losses. Stop loss is an automatic order placed in the market that closes positions should the market move against you. A stop loss can prevent losses from spiraling out of control. The use of stop losses is a very debatable topic, though. There's a lot been written about stop losses over whether they are actually beneficial or not. I've heard a lot of, I've certainly heard some so-called trading gurus who actually speak very disparagingly about the use of stop losses. Now that's great. I would say that they're in quite a privileged position by being very experienced traders. Not all of us are experienced traders, and I think that the use of a stop loss when you're not experienced is very important. My opinion is stop losses are an absolutely vital tool to your trading strategy, especially important if you are trading on a short-term basis. And as I said, if you are not, if you don't consider yourself to be a trading expert, unless you've got incredibly deep pockets, trading without a stop loss can have a crippling impact on your account, and also impact rather negatively on your night's sleep too. I'll give you an example. For example, just a quick example. In April 2015, the ECB had just started quantitative easing. Federal Reserve was seemingly on its way towards tightening. Everyone was bearish on the euro and bullish on the dollar. Being short on euro dollar was a very, very popular trade, whilst long dollar positions were consistently making money across the board. Happy days. However, mid-April, euro rallied 700 pips in just under 3 weeks. Cable rallied 900 pips in that time. Think about if you'd been running at short positions in either of these two, or heaven forbid both at the same time. Depending on your trade size that you took on, the losses may well have been crippling to your account. However, if you put a stop loss on, you would have been able to avoid these massive losses. I would say that stop losses are a vital part of your management, of the management of your trading account. Your pride can keep you in a stop loss. Well, I have a stop loss. Without a stop, it can be very difficult to manage downside risk on a trade. Human nature can kick in, and you may not want to cut a position due to the size of the loss. This takes me back to one of the issues I spoke about earlier with emotion trading, and that's pride. However, this loss can just become larger and larger, spiraling out of control. If nothing else, knowing the potential downside through having a stop loss in place will help you to have a better night's sleep. Also, identifying the size of stop loss is an important part of working out your risk per trade and the trade size you're looking to put on. Okay, how do you derive your stop losses? Well, a couple of ways: size, number of pips, and technical levels, supports and resistances. Looking at size first. Depending on the risk profile of the trader, often risk-reward ratio of profit target to your stop loss, it might be somewhere between 2 to 1 to 3 to 1. So if your trading strategy is looking for maybe 100 pips, 150 pips on a target on a trade, you may want to think about a stop somewhere in the region of maybe 50 pips. So it would depends on the conviction of the trade as to exactly the size of stop loss you might want to place on. Some traders, so technical levels. Some traders like to use technical levels such as key supports for long positions, key resistances for short positions, and these technical levels comprise of absolute price levels on the charts and Fibonacci levels as well. Oh, crikey. It's quite boring. Ideally, you would need to be given your position a little bit of room around these levels. This is because big banks will often sit around these levels knowing that retail traders will be sitting and placing their stops around key levels, and they will be able to hoover up the stops without the large orders. Around the large orders, blah blah blah. Back to that one. Couple of key tips. Never extend your stop losses. No, don't be tempted to adjust it. Trust your initial analysis. Move on. Management of your positions. Don't be idle in your trading. If you're getting close, don't be tempted to just. If you see you're getting close to stop, don't be. Manage your positions during trade. Don't sit idle as you wait. Watch a nice healthy profit turn into a stopped out loss. Active trade management can help to prevent this. If the conditions for your trade change whilst the position is still running, manage your position. As I said earlier, you need to be running positions, blah blah blah. Think about it, you know. So for example, okay, so position moves to 50 pips of profit, and you don't change your stop or your target, your risk reward gets skewed the other way. Effectively, therefore, the current position, you'll be risking a potential loss of 100 pips for a gain of just 50 pips, not a great risk or reward. So you've got a couple of options. You can adjust the stop to entry, so your risk reward becomes 50 pips of profit for 50 pips of loss, which is rather a risk-averse stance. Or you could tighten your stop even further to get yourself a guaranteed profit. Maintain your 2-to-1 at risk. Risk reward, and you'll be in place to place your stop 25 pips below market and maintain your profit trigger. Third option, both stop and target. The volatility you can take on the account is on your time horizon. It's like a trading stop on your charts. Show parabolics and Bollinger Bands right at the end. Fine. Right at the end. Fine. Okay, so we go like that. Charts. And we're looking at charts, doing this, that, and the other. So, do you reckon that's enough?
Yes.
So, do you stop it or do I stop it?